John Bogle wasn't your typical Wall Street hotshot. He didn't chase after quick profits or flashy investments. Instead, he believed in a simpler, fairer way to invest, one that would benefit the average person rather than just the wealthy elite. In 1975, he founded Vanguard, a company that revolutionized the investment world with its low-cost index funds. These funds track the performance of the market, offering a cost-effective way for people to invest. Bogle championed the everyday investor, teaching them how to grow their wealth steadily over time. He believed that everyone, regardless of their financial background, should have the opportunity to invest and build a secure future. His book, The Little Book of Common Sense Investing, became a bestseller. It demystified the world of investing, making it accessible to everyone. It's a guidebook for anyone who wants to take control of their financial future. Bogle's straightforward advice and practical tips have helped countless individuals make informed investment decisions. Bogle's message is clear. Investing shouldn't be complicated or expensive. By keeping costs low and focusing on long-term growth, investors can achieve their financial goals without unnecessary risk. He believed in empowering investors with knowledge and tools to build wealth gradually. Through education and transparency, Bogle aimed to level the playing field for all investors. His legacy continues to inspire millions to invest wisely and achieve their financial dreams. John Bogle's principles of simplicity, fairness, and long-term growth remain a guiding light for investors around the world. The Little Book of Common Sense. Investing cuts through the noise of Wall Street, offering a refreshing perspective in a world often dominated by complex jargon and high-stakes trading. It offers a straightforward approach to building wealth, making it accessible to everyone, regardless of their financial background or experience. The book's central message is powerful, yet simple. Buy and hold low-cost index funds. This strategy is not only easy to understand, but also practical for anyone looking to secure their financial future. This strategy, Bogle argues, is the most effective way for the average investor to grow their money over the long term. By minimizing costs and maximizing returns, investors can achieve their financial goals without unnecessary stress. The book debunks common investing myths and misconceptions, providing clarity in a field often clouded by misinformation and hype. It explains complex financial concepts in plain English, making it easier for readers to grasp essential principles without feeling overwhelmed. Bogle provides readers with the tools and knowledge they need to make informed investment decisions. He breaks down the barriers that often prevent people from taking control of their financial destiny. He emphasizes the importance of discipline, patience, and a long-term perspective. By staying the course and avoiding the temptation to chase short-term gains, investors can build a solid foundation for lasting wealth. Index funds are like baskets of stocks that track a specific market index, like the S&P 500. They offer a simple and effective way to invest in a broad range of companies without having to pick individual stocks. When you invest in an index fund, you own a tiny piece of all the companies in that index. This means you get to benefit from the growth of multiple companies, spreading your investment across various sectors. This diversification helps reduce risk. By not putting all your eggs in one basket, you are less likely to suffer significant losses if one company underperforms. Instead of picking individual stocks, you're essentially betting on the overall performance of the market. This strategy can be less stressful and time-consuming, as you don't need to constantly monitor and adjust your portfolio. Index funds are known for their low fees. These funds typically have lower expense ratios compared to actively managed funds, which means more of your money stays invested and working for you. Actively managed funds, on the other hand, charge higher fees to cover their expenses. These fees can include management fees, administrative costs, and other expenses that can add up over time. These fees can eat into your returns over time. Even a small difference in fees can have a significant impact on your investment's growth over the long term. Bogle believed that low-cost index funds provide investors with the best chance of earning market returns. His philosophy was that by minimizing costs and diversifying investments, investors could achieve better long-term results. By choosing index funds, you can take advantage of a straightforward, cost-effective investment strategy that has the potential to grow your wealth steadily over time. Many investors believe they can beat the market by picking individual stocks or timing the market perfectly. However, Bogle argues that this is extremely difficult, even for professionals. Trying to outsmart the market often leads to higher trading costs and emotional decision-making, which can be detrimental to your portfolio. Bogle emphasizes that time in the market is more important than timing the market. By investing consistently in low-cost index funds, investors capture the overall growth of the market over the long term. Trying to beat the market is a risky game that few win,